How do you take income from an investment portfolio in retirement, and how does risk play into that? Well, a lot of studies have been done on the topic. Trinity University study, Bengen study, they found that you needed to have anywhere from 50 to 60% of your portfolio in stocks in retirement. Well, why not 100% of your portfolio? Well, you deal with something called sequence of returns risk. The market goes up, everything's great, but when the market goes down, you progressively have to sell more and more shares to get your income from your portfolio. It can be a problem. So how do you deal with that? Well, you have fixed income. The right type of fixed income investments tend to go up in value when the stock market goes down. It's kind of like having two wells in your backyard. One is a stock well and the other is a bond well. When the stock market's doing great, you take your income from there. If the stock market's not doing so great, you take your income from your bond well to buy you time for when the market goes through its recovery, as it always has. Now, a lot of people say, well, forget it. I'm just going to put all my money in fixed income investments. I'm not going to take the risk. And they say, I'm just going to avoid risk altogether. Well, the problem is you take a different type of risk. If I divided my portfolio, let's use an example and say I divided my portfolio between large companies, small companies, large value, small value, international small companies, 5-year bonds, and treasury bills. What happens if I do that, if I divide it evenly and just captured market returns? Let's say that I took a 4% income off my portfolio. Whatever the portfolio was, I take 4% out. If it's 100,000, I take 4,000. If it's 150,000, I take 6,000. If I had done that, my income today would have started back in 1987 at 4,000. It would be just shy of 16,000 today, with a portfolio ending value of $389,000. What if I had done the same thing from a safe investment in treasury bills? My income would basically be the same, but my ending portfolio value would be 1/6 of the other portfolio. It doesn't take a math major to figure out that it'll just take a couple of years before I run out of money completely in that portfolio. So realize what happens if you don't take any risk. You can actually be taking tremendous risk. Not taking any risk can be very hazardous to your wealth in retirement.